Everybody, today is Saturday, the 13th of November, 2010. Had some difficulties with the audio, I guess, on the recording yesterday, so I'm going to make another one here, and hopefully you'll be able to hear as well what I'm saying. So let's take a look at the S&P 500. It's still in an uptrend. We came down to this rising 20-day moving average. That's kind of something that we've been thinking was a possibility of coming down to that 20-day moving average. We've been looking at this slide here that I put at the beginning of alphatrends.net each day. That is the video and the live video analysis, and we were observing that this rally looked very similar to, because it's, here we've got the red is the 10, blue is the 20-day moving average, and that green is the 50. But what we had seen was that the market, had that little consolidation, had a couple days rally, and we were basically right at that green candle last time we looked at this chart. And now, subsequently, what we've seen in the S&P 500 is that it did kind of come down and do what that chart did. So we got a little bit overextended. It pulled back down to the rising 20-day moving average. And what you don't see on both of these charts, on this chart here from the slide or this one here that we're seeing in real time, is what happens next. And I was trying to look for what that slide actually was, trying to figure out the chart, but couldn't figure it out. So we couldn't use that as an example. However, what I think is likely to happen is maybe a little bit further pullback to sideways consolidation. We could actually look at what's been a pretty good blueprint for this market has been the EWZ. The EWZ is the Brazilian index, and this market's been leading ours a little bit here, but it kind of had that pullback and then a little bit deeper pullback and rallied to new highs, and now it's having a little bit more trouble once again. I don't think that's necessarily the blueprint for the market. It's just something to be aware of. What we want to look at in the S&P 500 is we have to realize there's a multitude of trends here. We've got, on the weekly time frame, we've got obviously a nice uptrend. We've got a market that's rallied up to this prior level of resistance, and it's consolidating up in here. So when we see this prior level of resistance, prior support, which did become resistance later in the year, it's not unusual for at least a time correction in that area. It doesn't mean we're going to get a reversal or that this is a double top or anything like that. A time correction, would be the minimum of what to look for. And then we look at the daily time frame. We're still in an uptrend here, and we look at it and say, where have we come from? Well, we've had this 17% rally, 18% rally, right up to a prior level of resistance. We exceeded it by a small amount, but the market had been extended. Some profit taking was expected at some point. We did have the gap get filled for the SPY. So last week I was saying not all gaps get filled. It was possible that the market could continue to move higher. Of course, it didn't continue higher. What we had is we saw a gradual shift here, that this prior support there from last week at about 122 did become resistance on Wednesday. We gapped lower on Thursday, and we're stuck below that declining 5-day moving average, which tells us that you want to be more defensive and kind of move to the sidelines. Well, on Friday, of course, we had further selling. We had a gap lower. Market tried to recover. It got back above the volume weighted average price briefly. So this is just Friday's activity. It fell short of the pivot, got back below that VWAP, and then the sellers took control from there. And we still have, on this 10-minute time frame, a pattern of lower highs and lower lows. So we've got a downtrend here on the short-term time frame that comes within a primary uptrend. So it tells us that you could make money selling short in here, but most likely, if it's just a pullback within an uptrend, you're not going to have a lot of opportunity to short to the short side, and that you're better off kind of waiting for the market to kind of give us a signal here that it's healed and ready to turn higher again. When we look at, for instance, this is only the second day in this rally, third day actually, where we've closed below and above. Third or fourth, I guess, where we've closed below the 10-day moving average, but still above that 20-day moving average. So the 20-day moving average has really been the essence of trend, and if we take those lows and connect them, this is what our trend line looks like. So perhaps we're going to see a little bit further pullback, maybe down towards 119 next week before we do begin to stabilize. That wouldn't come as a huge surprise, nor would it be a trend damaging event if that were to happen. the bigger concern would be is if we just continue to drop down and maybe find support down along that 50-day moving average closer to about 116.30. That would be a deeper pullback that would have it would do more damage to people, I think. But markets correct either through time or through price. We're getting a little bit of a price pullback in here. If we bounce around a little bit, maybe for a week or so, and then drop down, I think the 50-day moving average would become more likely. But we still do have to give the benefit of the doubt to the buyers overall. We're in an uptrend, and this is just we have to look at it as a pullback within an uptrend for now. The biggest reason for concern right now, or what's really going to be important next week, is the financial group. Now, the financial group had been lagging severely. While the S&P 500 had that big rally, the financials really didn't do a whole lot until they broke out a week and a half ago, past the highs from the summer at about that 1505 area. Well, we broke back down through that on Friday, and that gives us reason for concern. We are still, though, above the 200-day moving average, and that's a big focal point for many people. If we look at this, the financial group, here's what we're looking at. Last week we said that, what could go wrong with this rally? Well, this is what could go wrong with the rally, is the financials. That if the financials failed to hold on to the breakout and they came back into the range and didn't recover, then it would put a cloud of suspicion on the overall market itself. And we're pretty close to that level, but we're not ready to give up on these financials yet. Sometimes what we see is we see a breakout, a pullback in that kind of just gets a lot more people short, and then it recovers, and you can get a much better recovery if the shorts have been aggressive in here, because if the stock market, the financials begin to recover, well, then they're going to have to cover, and we'll get new longs in there as well. Well, the thing that I don't like about this pullback right now is that it did close below that 10-day moving average. Generally, what you want to see in a healthy uptrend is that when the market breaks out, like the SPY, that we can at least hold that 10-day moving average. And then as the trend becomes a little bit more mature and profits, pullbacks get a little bit deeper, then we start testing the 20-day moving average. When we test the 20-day moving average with more frequency, we often turn sideways for a little bit and then correct down towards that 50-day moving average. Back to the financials, though, we didn't hold that rising 10-day moving average, and that gives us a little bit of reason for suspicion. If you're in the financials, here's what I think you need to be looking at. If you bought that breakout, as far as trading goes, well, this rally began, from this little shakeout low a week ago Wednesday to this high, and then we had a little pattern emerge here of lower highs and lower lows, and we're still in that pattern of lower highs and lower lows. So short term, we're in a decline. We're below a declining 5-day moving average. If we take a look at the essence of this trend from where it began, right here, this Thursday, this past Wednesday or a week ago Wednesday's low to the high, you can see we're right at that 61.8% retracement of this move. So here's a 38.2. This is a 50% retracement, and a 61.8% retracement brings us right here to where we are. So what we want to look at and understand is that, based on Fibonacci theory, anything greater than a 61.8% retracement is considered to be a failure. We're sitting right on that level. This is a key psychological level because you have longs who are looking at this saying, hey, it's at a 61.8% pullback, let's add to our long position. Or you have sideline cash coming in here nibbling in this area. You might also have people who shorted this rally and pushed it down saying, well, it's at the 61.8% retracement. Let's buy a little bit back so we don't get stuck if it reverses. So we have a little bit more demand, a little bit less supply, but all that means is this is where this battle is now being fought. This is the important battleground. 1495 on the intraday time frame to this really 200-day moving average, and the gap filled down at about 1475. I think below 1475, that's where there's the potential for trouble. That's where we look at this and say this is a failed breakout. From failed moves, we could see a fast move lower. So the financials are going to be very important next week. I'm kind of thinking they're going to hold on, but I'm not buying yet. I think what you want to wait for is this pattern of lower highs and lower lows to at least turn to neutral. And I think we're going to have to see at least a move above 1520. So you don't want to be bullish financials unless they get above 1520 at a minimum. But more likely, I think it's the $15.35 level. This prior support had become resistance here. And if this market can kind of rally back up towards 1520, maybe pull back a little bit, then rally up through 1520 and 1535. So in other words, create a higher low over here somewhere, and then find the energy to push up through 1535, well then we would have at that point a stage 2 uptrend on the short-term time frame, which would be in alignment with what appears to be this budding uptrend on the daily time frame. It's still it went from bullish to kind of neutral here on the daily time frame, where it's at an important zone, and if it can't get up off its butt here quickly, then a failure in the financials, I think, is going to lead to a deeper pullback in the S&P, perhaps down to that 50-day moving average. So next week we're going to have to be really aware of those financials. A lot of people for the last 2 years have saying you've got to follow every tick in the financials. I don't believe that to be true. This market rally, experienced a phenomenal rally without the financials participating, but now the financials have kind of taken center stage, and we've been talking about this group having the potential to take leadership and really lead the overall market to the next leg higher. Well, if it can't lead and this market is extended and it's searching for leadership from financials, and the leadership isn't emerging, then that means the people are going to start to kind of say, well, wait a minute, where's our leadership in this market? Let's pull back. Let's sell a little bit off, and maybe we're going to sell off. You could create a scenario where maybe we sell off through the end of this month or so, and perhaps we have a strong December, Santa Claus rally, whatever. That's getting too far ahead of ourselves. Really focus on these key levels here in the financials, and what's the psychology of the participants who purchased on this breakout, and now they're wondering whether they should take a loss, or if they're gonna add to it, or the people who missed out on this are now nibbling. You want to understand that psychology and what could happen if we get back down below probably 1470. Below 1470 would really be something that could lead to bigger weakness in the overall market. So those financials are very important next week. The Russell, not the Russell, but the Nasdaq 100 got pretty close to this multi-year high, up at $55. Again, ask yourself the question: when you see the market extended like this, where has it come from? Where does it have the potential to go before it's likely to encounter resistance or a big inflection point, a level that people are watching? Well, that 55 level is the big level that people are watching as. That's the price objective. We had run through this first level, and the second, or here's the first bigger level we had run through at about 50 and a half. And 50 and a half is actually going to be, if we get a deeper pullback, and it's only 2 points right now. So if we're going to get a 4% pullback, 4.5% pullback down to that 50 and a half level, it's not a big pullback, but what we would want to see is this prior resistance would in fact hold as support. That's going to be the key level to watch in there, and that's also where we conveniently have this rising 50-day moving average. So when we have a couple things come together technically that tell us, well, one group of participants is focusing on this prior level of resistance and thinking we'll stop selling when it gets to that resistance because it should become support. Another group is looking at that prior resistance saying, hey, if it pulls back to there, that should become support, so I'm going to start buying. And similar to that Fibonacci and the 200-day moving average in the financials, you have these, a confluence of groups of people coming to the same conclusion, that is, sell less and begin to cover shorts and nibble on new longs in that area. It becomes a self-fulfilling prophecy often. So 50 and a half is a big level for the Nasdaq. There's nothing to say we're going to drop right down to it. This is the second test of the 20-day moving average that we've seen since this rally emerged. And short term though, we have a pattern of lower highs and lower lows. So, maybe we get a little bit of a rally that falls short of this prior level and continue down. So you don't want to be a buyer yet because we have lower highs and lower lows. So don't be looking at the 20-day moving average and saying, here's where I want to buy because it's touching a 20-day moving average. The 20-day moving average is a visual reference point. It's something that says, okay, that's typically an area of support. It's a battleground. That's what we want to look at. Is it's a battleground where the fight for control is likely to take place. Now, who's in control currently? Who's in control currently? The sellers here over the trend of the last week. We have lower highs and lower lows. There is no evidence that the buyers have even had the ability to turn this market sideways in here yet. We're below a declining 5-day moving average. We have to wait for evidence that the market is at least turning sideways, and then once it begins to move higher, then we want to get long. So it's premature to buy in here. And as far as aggressive short sales go, we're still in a primary uptrend on the weekly time frame, the daily time frame. So if you're going to be a short seller, you focus on the short-term trends. When you have a market like on Friday where we gap lower, we try to recover. The market gets up above that VWAP and then fails, and then breaks that opening range and lower highs and lower lows below the volume weighted average price. Those are the times to be short, and for day trades only is my opinion. Unless you sell short up here, you cover part of it maybe, I don't know, in here, and you want to hold on to a couple hundred shares over the weekend because maybe you think disaster's coming for whatever reason. But again, looking at headlines and what motivates people to buy and sell, we had a lot of talk about the permanent open market operations, POMO, or known as QE2, quantitative easing 2, where the Federal Reserve goes and buys bonds, and that's on those days, the POMO days. Here's how the equities have performed versus non-POMO days, and this is a chart I had put on my blog courtesy of Billy O'Neill O'Neill rather, from Value and Time Google Group. But this chart, what it represents is the days when the Federal Reserve was in there buying treasuries, and that equities performed very well. And on days they didn't, kind of lackluster performance. So, and that's since August 31st. So we look at this and we say, well, it looks like when the Federal Reserve is in there, you got to be a buyer of equities. Not that simple. Only price pays. That's a good piece of information. But if you were buying equities on Friday because you thought, hey, this is the beginning of the permanent market operations, was Friday, that the Fed is going to go on, I believe, the next 8 days and continue their operations. It's not just free money. Okay, you lost 1.65% on that theory. And what's more important than any headline or any news is, what's the direction, intermediate term, of that 5-day moving average, which is heading lower. So again, there's another example of only price pays. Headline risk is that, hey, you know what? People knew this quantitative easing 2 was coming. Is this a case of buy the rumor and sell the news? So far, it seems like it. So it's just, those are just things you want to keep in mind. The Russell 2000, as we know, recently broke some resistance here at about 71.5. It's enjoyed a nice run. Hasn't quite closed that gap yet. Still above the 20-day moving average. We'll look for that 71.5 area to be the first bigger level of support. If the market breaks that, then maybe you look at a trend line like this, which would bring us down towards about 71 or so. But realistically, this market has gotten a little bit extended as well. If we could see, the most bullish thing would be maybe a little bit further pullback to sideways activity, and the market kind of heals for a week or two. Wouldn't be a bad thing. The semiconductors had a deeper pullback this week and actually recovered pretty nicely. The bigger level in here we would be looking at, if we were to see continued selling in the semiconductors, we would want to see that prior important resistance level where this rally just began from does hold as support. Looking at a 30-minute time frame or even just a 10-minute time frame, we've got a declining 5-day moving average that declining 5-day moving average. The market rallied right up to it. There were sellers there. So semiconductors are going to need to get back above 31 or so for a trend to emerge. Let's see, oil. Oil looked like it was breaking out, the USO, and now after Fridays, it's kind of putting a question mark on this breakout. We had these two levels that were broken to the upside, and we had a pretty sharp pullback in there. So, it looked like maybe oil was headed for about 39 and a half, if you recall. We had a sharp pullback, and I think it caught a lot of people off guard. Now, this group is also below a declining 5-day moving average, so you're going to want to wait for that to heal and recover back up through that 5-day moving average before you give it the opportunity to be long. The gold and silver, the precious metals were pretty volatile this week. They had that one big down day, and then a day that I think, a couple days that kind of did what Las Vegas Sands did. With a lot of people called this day the top, and so far it is. But they had two rough days. The shorts did in LVS. Let's take a look in there. Let me just do this. LVS. The shorts had two rough days before they got rewarded. So here was everyone was calling the top on a Friday, and then it rallied and it went sideways, and then it gapped lower and got hurt. But back to gold. Gold obviously had that one big down day, and then 2 days, same thing of suffering in here. Yesterday we saw a gap lower and continuation lower. So what we want to look at in gold is, what are the key levels? We're right at that 20-day moving average and this prior resistance. So if this area breaks 132.50, then the next bigger level will be found. I didn't draw that the way I wanted to, but down here at about 129. So gold probably needs to heal more in time. It's not. To me, I don't think it looks like the top. It could be. We'll know in 6 months maybe, but right now you still want to give the benefit of the doubt to the buyers until we start breaking down below some of these bigger levels and the moving averages begin to turn sideways to lower. Anyway, that'll do it. Enjoy your weekend. We'll talk next week.